Hello, everybody, and welcome. My name is Bennett Tchaikovsky. We are going to be going over here today, and we're going to be going through a basic, comprehensive financial accounting statement creation. This would really be kind of considered for the very first exam. This is by myself, also known on YouTube. It's Bennett Tchaikovsky, also known as the accounting professor on YouTube. This is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without the prior written consent from the author. Also, any opinions or statements contained herein are those of my own and not my employer's, Irvine Valley College, or the South Orange County Community College District. So let's get to it. So we're going to go ahead and take a look at this question. We have WC, Chopin Inc. Got to go a little classical once in a while. Provides services, or DCI provides services for various clients. DCI had the following transactions for the 2027 year. So we've got on 1/1/27, Claude and Frederick each contributed $300,000 to DCI and received common stock. During 2027, they provided services and received $725,000 cash from clients. We paid a consultant, Stravinsky, $327,000. And then we purchased at the very end of the year, purchased equipment for 126 by paying $37,000 cash and placing the remaining amount on a note payable. Gives us some information about the note payable, and then we had a dividend. So first step over here, input the transactions into the T accounts. So as we're kind of looking at, you'll kind of see a common theme that when I'm going through and doing these questions, you're going to see a lot of questions repeat themselves. And this is really because you want to kind of learn by practice and repetition. That's how we're going to learn accounting. So, and we want to write it out, right? So the more you handwrite it out, the stronger it will retain and the better off you're going to be. So coming over here, we have to remember our formula: debit, credit. Assets equals liabilities plus owner's equity. So first one over here, Claude and Frederick each contributed $300,000. So let's kind of take a look at what's going on here. So we have right over here, we have Claude and Frederick, and we are DCI. Let's do that over here. Okay, so we are DCI. So Claude is giving us 300,000. Frederick is giving us also $300,000, right? So they're receiving a total of 600,000. And in exchange, we are going to be giving Claude and Frederick common stock. Okay. So if I'm doing this from the perspective of DCI, right, what I'm going to need to kind of go through and do is to say, okay, we're receiving 600,000 of cash. So this would be letter A. So we're receiving $600,000 in cash. And then for every debit, I need a credit. Remember, cash, we're receiving it as an asset. We show increases to asset with debits, decreases to assets with credits, right? In exchange, I'm giving Claude and Frederick common stock. Common stock is part of owner's equity. So coming over here, we're going to go over here and basically look at common stock. So we're going to credit that for basically for 600,000. Okay. Now, when we look at letter B, this is going to be brand new from the last video. And the last video we did in this series really focused on, okay, all of these transactions happened on December 31st. And the real purpose in giving you this question was to help you get ready in terms of how do we record basic financial statement transactions, which is really important to do. But now what we're doing here is like, well, companies don't essentially operate on one day out of the year. They're operating throughout the year. And if we come over here to sec.gov, and I'm going to do search filings, and let's go to our friends at the Home Depot. Okay, so let's go ahead and take a look at the depot. And when I look at the Home Depot, right, we have our balance sheet, right? So Home Depot has roughly assets of about 96 billion. They have liabilities of about 92 billion, and then they have equity of about 4 billion. So their assets equals liabilities plus owner's equity. However, Home Depot doesn't operate during one day out of the year. They operate throughout the year. And in the course of that year, how does Home Depot make money? Well, they purchase inventory and then they resell that inventory. Now, if you're taking one of my classes in these first two exams, I'm not going to be dealing with inventory sales. It's a little bit more complex. But when we do have a sale, we are going to be going through and recording something called revenue. And what is revenue? Revenue shows, and by the way, the definition of revenue is there's a 5-step process, but this is not intermediate accounting. This is lower division financial accounting. We're just learning basically the basics. But essentially, when I want you to think about revenue for right now is we've performed a service and there's no further obligation on our part. Doesn't matter whether or not if we've received cash for those services, but we've performed services. That's the key. If we've performed the services, then we can recognize revenue. Okay. And revenue is telling us for a period of time, how much did we generate in terms of sales? So kind of like, just like let that thing part sink in. So if I've performed services, right? I've done everything I need to do. I'm hired to perform legal services. I perform those services for a client, send my client an invoice. The client sees it. Yep, Bennett did all this stuff. They send me money, right? That's really kind of what we're talking about. So we provided services and received 725,000 in cash from clients. So what we're going to kind of assume is that DCI has done everything they need to earn this money. So let's kind of think about over here what's happening. Let's do the easy part first. What's happening to cash in transaction B? Well, we have clients. So clients are giving us 725,000. Right. So clients are giving us 725,000 in cash, right? So I'm receiving cash. So how do I show an increase to cash? It's no different. I'm going to basically debit cash over here for 725,000, right? That's what I'm going over here and doing. So now the trickier part comes in when we say, okay, but for every debit, I need a credit. Now, notice from the last question we did, which I'll go through and link that video below. But when we look at letter C, Monkey, and these are transactions that took place on December 31st, 2026. Monkey Rally gave 59,000 to TRI for future services that TRI will perform in the future. So they got cash from Monkey Rallied. However, it's not revenue because they haven't done the services yet. So it's something we're going to call unearned revenue, which is a liability. What we're going through and doing here is we've basically have performed the services. So what we're going to do is we're going to record revenue because we've performed those services. We've done what we need to do in order to basically to have received, basically we've done everything we've needed to do to show that we've earned that revenue. Don't have to do it in the future. Now, when it comes to revenues, how do we record them? Well, revenues are something that are going to go on something called the income statement. The income statement tells us for a period of time, 3 months ended, 6 months ended, year ended, how much did we earn in terms of revenue, or how much revenue did we generate during a period of time. The way we're going to record revenues is with a credit. So coming over here, we're going to credit revenue, consulting services revenue for $725,000. Okay. So revenues are what we call a temporary account. They're an income statement account because we show revenues on the income statement. And what the income statement is the income statement is going to tell us for a period of time, basically our revenues, what we generated, less our expenses or the costs against those revenues. Let's go back over here. So that's letter B. Let's take a look at letter C. During 2027, I paid a consultant, Stravinsky, $327,000 for services that SI basically rendered to DCI. SI does not need to perform any other services for DCI. Okay. Now, similar to, let's go back to question 1. We had over here, TRI pays a consultant, right? Here, we're basically paying a consultant, right? This question here, basically, I paid a consultant. Okay. But on this one that we looked at previously, I paid a consultant, but it was for future services, right? Not for current services, but for future services. So when you look at this over here, I'm paying a consultant, and this is going to be for future services, right? So let's do the easy part first. Let's go over here and look at, so we've got Stravinsky, and we're paying Stravinsky Inc. We are paying $327,000. So we're giving Stravinsky $327,000 in cash. So when we're going through and giving Stravinsky $327,000 cash, what's happening to cash? Well, if I'm paying somebody money, cash is an asset. And if I'm paying somebody money, I'm going to show a decrease to that cash with a credit. So right over here, I'm going to be going through and crediting cash for $327,000. Okay, so I've got a credit to cash for $327,000, but for every credit, I also need a debit. And this is not going to be a prepaid expense because Stravinsky has already rendered all of the services. So what we're going to do is we're going to record an expense. And this is basically our cost of doing business. So what we're going to do is we're going to debit consulting services expense for $327,000. So right over here, we're debiting consulting services expense for $327,000, and we're going through and we are crediting cash. Okay, now revenue is an amount we've earned over a period of time. When somebody provides me consulting services, that's great, but it's a cost of essentially generating those revenues. So it's a temporary account, and it is going to be an expense. So they're giving us consulting services. They're giving that to us. They're providing us consulting services. We're giving cash. And so when it comes to recording expenses, we're going to be doing that with a debit. Okay, we're not going to be doing it with a credit. We're going to be doing that with a debit. Very, very important distinction. So when we look at the T account, we've added on a new layer. Over here, we've got expenses, and revenues. What is the place I never want to end up with at on the weekend or at any point in time is the emergency room or the ER. We're going to basically over here, we're going to debit expenses. We're going to credit revenues. Okay. So consulting services expense, I've used the services of somebody else. There's no future obligation. And when we look at a company like the Home Depot, you'll see over here, like we've got gross profit, talk about that in a future lecture, but then we get down over here to operating expenses. And let's just kind of go maybe look at a different company really quickly that might be a little bit more applicable to us in terms of the type of work we're going through and doing. And let's look at our friends at Meta Platforms that know everything about all of us. Okay, revenue, right? So Facebook or Meta Platforms had 39 billion of revenue, and then costs and expenses, right? So you see over here, expenses, those are reductions, right? So you're basically taking your revenues minus your expenses, and that is giving you your income, right? So this is the concept of an income statement, right? Or what we earned over a period of time. Let's come back over here. So we've looked at A, B, and C. So this is a new thing, right? We're recording revenues and we're recording expenses. My general advice to you is to follow the money, right? It sounds like All the President's Men, the film that was actually turned out to be about Mark Felt, who, if you know that reference of the director of the FBI, who basically told Bob Woodward and Carl Bernstein about Watergate, follow the money, right? So what I like to do oftentimes is because if I know that cash is decreasing or increasing, that can kind of give me to the right result. Okay, over here on 12/31/27, which is the very end of the year, I purchased equipment for $126,000 by paying $37,000 cash and placing the remaining amount on a note payable. Now, if you watch the previous video, right? Oh, does this look familiar? Yeah, I bought equipment, right? So as you're going through and doing these questions, you're going to see a lot of transactions repeat themselves. Why is that? Well, there's really a limited universe in terms of what I can actually go through and teach you, or the numbers of transactions. Now you're going to get some funkier transactions, but that's can be for intermediate accounting or when you start practicing. So as a CPA. So coming over here, the vendor is going to give us equipment. And this equipment has over here for 126K. So equipment is an asset, right? So I'm going to show that increase to an asset with a debit. Okay, so I need to find equipment. Perfect. Okay. Now, the question now becomes, if I'm debiting equipment for 126, how am I paying for that equipment? Well, it tells me over here that I'm paying 37,000 cash, right? So coming over here. However, my problem is a debit of 126 does not equal a credit of 37. So over here, I'm crediting this over here for 37,000. Right? So I'm crediting this for 37,000, but I'm not balanced. Well, I know I'm not balanced, but here I'm really not balanced. So coming over here, I've got 120. You would not be balanced either if you went to law school. So coming over here, I need a credit for 89. Now, what is that 89 going to be? Well, it tells us that the remaining amount is going to be placed on a note payable. So coming over here, I'm going to be giving that vendor a note payable for the difference. So coming over here, note payable, I'm going to be crediting this for 89,000. Now my total debits equal my total credits. So I'm good to go in terms of that particular transaction. Now, I'm going to say this over here. I use the specific date of December 31st, 2027. Why is that? Because I did not want to accrue interest. Now, when we get to the next exam, that's when we would have to go through and make what we call an adjusting entry to adjust for the interest. But as we're beginning, that's way too much though. As we're beginning to learn accounting for this first exam, disregard that very amount of interest. Just disregard it. Don't, even if you see interest, to say, Tchaikovsky's trying to trick us, right? Telling you the trick, it's trick or treat. Actually, there's no treat, but it's not October 31st yet, but maybe that day comes soon. So no payable bears interest at 10% will be paid in the future. Don't worry about that part. Okay. So coming right over here to this very next one. Now, what is a dividend? So as a corporation, when I look at net income, right? So I have my revenues less my expenses. The amount of money I'm going to be generating is going to be roughly about 398,000. That's how much I generated. Now, if the members or if the directors of the corporation, okay, and I have some other videos about what exactly directors are that I'll share with you a little bit later, but they can decide that they say, hey, we want to give back some of this money to our shareholders. We want to give back these earnings to our shareholders. And if we go over here and look at a company, and I think I can probably find one in Apple. So Apple, okay. So right over here, what you're going to basically say is you're going to see net income, and then you're going to see something over here. And this is called the statement of retained earnings. And we're going to talk about this. The concept of retained earnings is that when the company makes profit, right? Like right over here, like revenues minus expenses equals net income. The concept of retained earnings, well, how much of those retained earnings are we going to be going through and actually keeping? How much of those earnings do we actually get to keep? And so the concept of a dividend is that the company or the board of directors of the company is choosing to give some of those earnings back to the shareholders. But let's go through and try to figure out a way to figure this out. So I paid a $50,000 dividend. And again, if you've had experience, we know there's a date of record or declaration, a record, and distribution, right? Let's go through and talk about that. So we do that later on. So coming over here, when we're paying a dividend, let's just kind of look at it like this. So DCI is giving $50,000 cash to their shareholders. Now, it doesn't say here to each shareholder or to every shareholder. It just says a $50,000 dividend. So don't read more into it. It says 50 grand. So my cash is going down. How do I show a decrease in cash? Well, cash is an asset. I'm going to show a decrease with a credit. So coming over here, I'm showing a decrease to cash with a credit. Now, cash is being decreased for $50,000. Now, for every credit, I need a debit. Now, when I give back to the shareholders, very important, this is not an expense. An expense is a cost of doing business. A dividend is a decision by the board of directors of a corporation to give money, take those earnings that the company has earned and give it back to the shareholders. It's not a cost of doing business. So therefore, what we're going to do is we're going to debit an account called dividends, which means how much did we give to our shareholders during a particular period of time. So I don't have one other than it doesn't really kind of fall in as an expense. But when you see this, you can say DD or debit dividends, or you could say it's basically double down, whatever you want to call it, like DD, we're going to debit those dividends. But if you follow the money, I paid cash as a dividend. I'm going to show that over here as a credit. And basically, this is going to be shareholders, basically, and I'm also basically in the form of a dividend. Okay, so I've done all this part here. So the first one, I've input transactions A through E. Again, new concepts here. Revenue, what I've earned during a period. I have no future obligation. I've done the work. Expenses, the cost of generating those revenues, right? And it's expense. We're going to debit those expenses. Dividends, I'm just choosing, it's not an expense, but I'm choosing to give back to the shareholders. And that's basically going to be the concept of what we call a dividend. Now I need to prepare over here, prepare an unadjusted trial balance. So we've got some new categories here. So when we look at this, okay. So in our last example, or the last one we went over here and did, we basically had over here, in our solution, we went assets, liabilities, and then we went to equity, right? But we have some new friends that are joining us for the journey, mainly dividends, revenue, and expenses. And we're going to have this concept of a new account called retained earnings. And we'll talk about that momentarily. But over here, we have assets. We're going to have liabilities. We're going to have owner's equity. We're going to have dividends. Then we're going to have revenues. And then we're going to have our expenses. Again, don't have to do it this way, but I'm going to show you why it's going to be really, really helpful. So for our assets, we have cash. But before we go through and do this, we need to total up each of the accounts. For cash, we received $600,000 from our shareholders. We got $725,000 by performing services. The credits, I gave up $327,000, or I paid a consultant $327,000. I paid a $37,000 down payment for a machine or for equipment, and then I paid a dividend. So I subtract the smaller from the larger side, and I end up with cash of $911,000 debit. Okay. Common stock has a balance. Common stock is part of owner's equity. So owner's equity is going to have a credit balance over here of $600,000. For my liabilities over here, notes payable, that is going to be a liability. And I can also abbreviate this, at least for my class, with NP. That has a credit balance of 89,000. Equipment is an asset. So over here, I've got equipment over here for 126,000. Coming down over here, I'm going to have consulting services revenue. My consulting services revenue has a credit balance of 725,000. My consulting services expense, this is an expense. I've received the benefit of the item, or the services could be at 327, and then my dividends will be at 50, right? Remember, when we're doing a trial balance, the purpose of going through and doing a trial balance is to make sure that our total debits equal our total credits. Now, for retained earnings, this is going to start out with a zero balance. Why is it starting out with a zero balance? Well, earnings is the amount of the net income that the company is keeping. And this is basically, they formed the corporation on January 1st. So without any further information, our beginning retained earnings balance is 0. Retained earnings is part of owner's equity, and it's what is going to link basically the the income statement to the balance sheet. Okay. Now, when we come over here, I'm going to total up my total debits, and this is equal to 1,414,000. And then I'm going to do my total credits over here. My total credits are 1 million. Uh-oh. By the way, please take an Excel class with Professor Kusoy or Professor Mather at Irvine Valley. My Excel skills are absolutely terrible, but it's one of those things you want to kind of go through and record and basically do. So, and we're going to call this our unadjusted trial balance. Okay, so this is basically after inputting the transactions, this is our trial balance. Okay, again, our total debits equal our total credits. So coming over here, right, total debits equal total credits. Now, the next thing we need to go through and do is let's look at the list. So we prepared an unadjusted trial balance. Now we're going to prepare an income statement for the year ended 12/31/27. To prepare an income statement, let's go ahead and look over here at perhaps we look at Meta Platforms, formerly known as Facebook, revenues, income statement, the 3 months ended. So I'm going to take a brief pause. Okay, so going back to our income statement, we're going to be going ahead and showing our revenues for what we generated during the period in terms of, I don't want to call it income, but revenues, less our expenses. And so we're going to go ahead and set up our income statement. The way we're going to do this is it says prepare an income statement for the year ended 12/31/27. So whenever we do a financial statement, really important here, we're going to basically say the name of the company. In this case over here, it is going to be DCI. And this is going to be the income statement for the year ended 12/31/27. And the way I want to remember how to label this is I just want to come over here, prepare an income statement for the year ended 12/31/27. I'm going to go ahead and copy that right over here. Okay. So the reason why we set up the trial balance the way we do, assets, liabilities, owner's equity. And when we did this for the last problem, it was because, oh, we can create the balance sheet much easier. But when we come down over here, we're doing assets, liabilities, equity, dividends, then we have revenues and expenses. So all I'm going to do here is our revenues. So we have over here consulting services revenue, and this amount over here was a total of 725,000. Total revenues is going to be at 725. You may just have one line. That's fine. I kind of like to over explain things, as you've learned from my videos. This can't be turned into a TikTok, or if it can, I need to talk or tick because I have no idea how that's going to happen. Expenses, consulting services expense. This amount over here was at 327. Notice over here, I'm not putting anything where it says debit or credit. I'm just listing the revenues. When we prepare financial statements, we use debit or credit to help us record transactions. However, we're not using debits or credits in terms of doing the other part. So my total expenses are going to be 327. So my net income, or what I went through and generated, is going to be 725, which is my revenue, minus my expenses, or my net income is going to be 398,000. So right over here, this is my income statement for the year ended 12/31/27. Now, got this part of it done. Let's do the next statement. The next one over here is basically going to be prepare a statement of retained earnings for the year ended 12/31/27. So follow the same example. DCI, statement of retained earnings for the year ended 12/31/27. Okay, so over here, we're preparing a statement of retained earnings for the year ended 12/31/27. Now, what is a statement of retained earnings? It's the amount of net income. It's really, I should say, it's this. It is going to be our beginning retained earnings, right? Or how much income have we generated previously? Since this is the first year of the company, it's going to be zero. It will always be zero for my questions unless I'm giving you maybe a specific problem where I say, well, here's the beginning retained earnings, dividends, and net income. Make a statement of retained earnings. I think I've given that before on an exam. So basically for these types of questions, and especially when we're getting to learn accounting, it will always be zero because it's the first year of our operation. So if we kind of think about it, it's how much of the net income is the company keeping. So I'm going to add over here plus my net income. Now, my net income, the reason why we do this statement second, I have to do an income statement prior to basically doing a statement of retained earnings. So right over here, I have my net income. Now, how much of this did we give back to our shareholders? Well, this is going to be less our dividends, right? And the amount of dividends we gave up was basically 50,000. So we're going to have over here my ending retained earnings, or what the company is going to be going through and keeping, is going to be 348,000. I'm just showing you this line over here in terms of how I'm doing it. It's beginning plus net income over here. So my ending is my beginning. A plus B minus C equals D, right? So my ending retained earnings is 348,000. So again, new concepts here, right? We have revenues generated during a period of time, right? We generated 725,000 during the year. We had expenses of 327,000 during the year, and we paid dividends of $50,000. These here are what we call temporary accounts, okay? Everything here is a balance sheet account. These are what we are going to call permanent accounts, okay? Very important distinction. Our cash is our cash. It's not going to be going anywhere. So now that we're at the end of the period, one of the things we're going to have to go through and do is we're going to have to get the financial statements ready for the next period. And to do that, what we're going to need to do is we're going to have to close out our temporary accounts to retained earnings, right? So we're going to close out our temporary accounts, these over here, to retained earnings. So after we close out our accounts, the amount of the ending retained earnings should be a $348,000 credit. Now, if you're taking a class with another instructor, they'll sometimes do this crap called income summary, right? I don't like doing that, right? It goes to retained earnings. It's what the company is keeping of the net income. So I shouldn't probably call it crap, but it's kind of what it is. So what we're going to go ahead and do right over here is we're going to bring forward, right? It sounds like something from The Exorcist. Okay, come forward, devil. Okay. I have retained earnings, right? My retained earnings balance, right? It's part of owner's equity. Owner's equity has basically a credit balance. So when I come over here, I basically have my retained earnings, and I'm going to bring forward my temporary accounts. My temporary accounts are going to be consulting services revenue, consulting services expense, and dividends. Okay. Consulting services revenue had a balance over here of 725,000. Consulting services expense over here had a balance of 327. Over here, my dividends had a balance of 50,000. All I've done so far is I've carried over those balances. When we are close, and by the way, if you're taking my class, this is big points, right, on your exam. The recording of the transactions for the first test, those are a lot of points. Making the trial balance, not a lot. The financial statements, not so much, or they're a little bit more. But this part here, big points. And you have to do it this way. I'm very, very particular about it. So we need to make these accounts go to zero. Okay, so let's go through and do it. So how do I make consulting services revenue go to zero? Well, if I come over here and I make a $725,000 debit, I now have 725 and 725. This now goes to zero. However, for every debit, I need a credit. I close out the temporary accounts to retained earnings, right? So if I look at this over here, close out the temporary accounts to retained earnings via T accounts. That's what we're going through and doing. This is what we call the closing process. We're closing out our temporary accounts, which are revenues, expenses, and dividends, to retained earnings. So I'm going to come over here and I'm going to credit retained earnings. For every debit, I need a credit. Now, coming over here to consulting services expense and to dividends, I have to close these out. I have to make these accounts go to zero. So over here, to make this go to zero, I need to credit consulting services expense. 327 minus 327 equals zero. However, for every credit, I need a debit. So if I'm crediting consulting services expense to make it go to zero, I have to debit retained earnings. Dividends. Over here, I have to credit dividends. This is going to make the account go to zero. For every credit, I need a debit. So right over here, I'm going to go ahead and debit retained earnings. So for retained earnings, I've got over here a total of 377,000 of debits, and I have 725,000 of credits. To get my ending balance, I subtract the smaller amount from the larger balance, and I leave the remainder on the larger side. And over here, my ending balance is 348,000. Now, many of you might be saying, wow, Bennett, this looks familiar. It should, because it's the way we check our work is that this is going to be the ending balance of retained earnings. It comes over here from the statement, right? So this is how we go through and check our work. Okay. That's how we go through and close out our temporary accounts to retain earnings. Remember, revenues, dividends, and expenses, if you kind of look at it like this, this is showing for a period of time. If I never closed out the accounts, these numbers would grow, expand, basically keep on expanding. Rather, I need to know, well, how much income did we make during a particular period of time? And just to look at this really quickly, I do not know if pays. Okay, here we go. So as you kind of see over here, this is what we call a statement of shareholders' equity. Retained earnings is kind of embedded in this. But if we see over here, you got basically net income minus the dividends, the balance of retained earnings at the beginning, gives you the balance at the end, but we're doing it in a much more simplified fashion. Okay. So I come down over here and I'm now going to go ahead and look at, prepare a post-closing trial balance. Okay. Now, what exactly do we mean by a post-closing trial balance? Okay. So when we look at this, a post-closing trial balance simply is basically saying, okay, after we closed out the accounts to retained earnings, what's my new balance of dividends? Well, after I closed out the account, my balance in dividends is zero. What's my balance in consulting services revenue? Well, I closed it out, so the balance is zero. Well, I closed out my consulting service expense, so what's the new balance? Well, that new balance is zero. If I come up over here to retained earnings, by the way, is the balance no longer, is it still zero? No. The new balance of retained earnings is going to be 348,000. Okay. So when we're doing a post-closing trial balance, the revenues, expenses, and dividends are all going to go to zero. And I'm going to have a new balance, not a shoe, but a new balance of retained earnings, dad joke, based on right over here, coming over based on the statement, based on that closing process. None of the other balances will change. I still have common stock of 600, still have notes payable of 89. I still have equipment and cash of 911,000. So my total ending balances, my total debits still equals my total credits. So again, the closing process, I'm just closing it out to retained earnings. Many of you will be learning this from a book where they like to teach you crap about income summary. I just don't care to do that. So we've done these two parts over here. This is the post-closing trial balance. That's what we did. Now we need to prepare a balance sheet. Remember, this is a really simplified balance sheet. It's not classified. We're just dumping assets and liabilities and we're going from there. But at this point, it looks a lot like what we just went through earlier for the last problem and just said, assets, liabilities, total liabilities, owner's equity, total owner's equity. So when I come over here in terms of saying DCI, balance sheet, and remember, it's not for the year ended, it's a snapshot in time. If I was saying for the year ended for cash, our balance changes as daily. So over here, we're going to follow this as of 12/31/27, name of the company, right? If you're taking my class, I am concerned about formatting of financial statements and labeling them. DCI balance sheet as of 12/31/27. So balance sheet, AELOE, assets equals liabilities plus owner's equity. Assets, I have cash and I have equipment. My cash was 911. My equipment was 126. My total assets are going to be 1,037,000 right over here. What am I proving on the balance sheet? Well, I'm going through improving that my total assets here for Meta Platforms is 230 billion, equal my liabilities plus my owner's equity, or a total of 230 billion. I'm showing that my total assets equals my liabilities plus my owner's equities. So my liabilities over here, we're just going to have notes payable at 89,000. So my total liabilities are going to be at 89,000. Remember, this is a very simplified example. When we do other ones, it's going to get more complicated with more accounts. Coming over here, I've got owner's equity. Right, I've got common stock, and we can abbreviate, at least you can in my class. And then we've got retained earnings. My common stock was 600,000. My retained earnings was 348,000. The retained earning tells us how much is the company keeping of that net income. So my total owner's equity is going to be 948,000. I'm not done though, because I'm not showing the balance here. I'm not showing that my balance sheet is balanced. My total liabilities plus my owner's equity is going to be 89,000 of my liabilities plus the 948, or 1,037,000. So that's a very simplified balance sheet creation with revenues, expenses, and dividends. When I look at, and I'll show you as we're going through and learning, we're going to have more complicated problems, more complicated questions, right? But this flow of how things work for the first exam, we don't do adjusting journal entries on the first test. Why not? If I threw in adjusting entries, I actually tried that once, it didn't work out. If I threw in adjusting entries in this exam, you would really be messed up. It's more important that for this test, we're recording transactions. How do we record our debits and credits? And then how do we go through and summarize them, right? So we recorded them here. We make an adjust trial balance. We go through and we prepare financial statements. We close out temporary accounts to retained earnings, right? When we're doing accounting, there's going to be a lot of checks and balances, right? Make sure that your total debits equal your total credits. Also over here too, label your transactions. Why is that so important to do? Because I can say here, oh, 600, 600, if I get something wrong, right? But if you're taking my class, I give partial credit, which is kind of the part of the reason why I give problem-based exams. So in any event, that's what I would have suggested for you in terms of kind of what to go through and do. So have a great rest of your day. Thank you for joining me here. And if you have any questions, feel free to leave them below in the comments. Appreciate you liking and subscribing to the channel, and I'll see you on future videos. Have a great day.